Hi friends, good day. Today let us try to understand about what is market capitalization, what are the types of market caps, factors impacting market caps through this video. According to Paul Samuelson, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Before we go in,
Please subscribe for more videos. Click the bell icon for updates.
what is market capitalization? Market capitalization, also called as market cap, which is the total market value of the company's outstanding shares of stock. It is calculated by multiplying the total number of outstanding shares by the current share price. It gives us the total worth of the company on the open market, as well as market's perception of its future prospects, as it reflects what the investors are willing to pay for its stock. For example, if a XYZ Limited company have outstanding shares of 1 million and the current price of the share is rupees 100, then the total market cap of the XYZ company will be 1 million into 100, which is equal to 100 million. The formula of market capitalization is equal to outstanding shares into current market price of a share. Shares outstanding are the number of shares of a public company that are currently held by shareholders. Market cap is quick and easy method of estimating the company's value by estimating what the market thinks it is worth for publicly traded companies. By using market capitalization, we can estimate the size of the company, and it is important because size is the basic determinant of various characteristics in which investors are interested, including risk. The strengths and weakness of stock market capitalization. Stock markets can sometimes be misleading when comparing one company to another. Stock market capitalization, on the other hand, ignores capital structure specifics that can cause the share price of one firm to be higher than another. This allows the investors to understand the two companies' relative sizes. On the downside, stock market capitalization is limited in what it can tell us. The biggest weakness of this particular metric is that it does not factor into consideration a company's debt. Another major weakness of using stock market capitalization as a proxy for a company's performance is that it does not factor in distributions such as spin-offs, split-offs, or dividends, which are extremely important in calculating a concept known as total return. The total return can result in investor making money even though the company itself goes bankrupt. Given its simplicity and effectiveness for risk assessment, market cap can be a helpful metric in determining which stocks are interested in and how to diversify the portfolio with companies of different sizes. Now let's look into types of market caps. Large cap. Large cap companies are the firms with a market value of $10 billion or more than rupees 20,000 crores. These firms often have a reputation for producing quality goods and services and also have a history of making the payments like dividends at the right time consistently and have steady growth. They are often established within their industry and are dominant and have their brand names known to the national consumers. As a result, investments in large cap stocks may be considered more conservative than the investments in mid cap and small cap stocks, posing less risk in exchange for less aggressive growth potential. Mid cap. Mid cap companies are businesses with a market value between $2 billion and $10 billion, or above 5,000 crores and less than 20,000 crores in rupees. Typically, these are established companies in industries experiencing or expected to experience rapid growth. They are in the process of growing, increasing their market share, and improving their overall competitiveness. This stage is very important as this determines whether the company eventually lives to its full potential. The risk also falls in between the large cap and the small cap. They offer a growth potential more than the large cap and risk less than the small cap. Small cap companies. Small cap companies are those companies with a market value of $300 million to $2 billion or less than 5,000 crores. These are the young companies that serve niche markets or emerging industries. They are the most aggressive in the third categories. The small cap stocks may offer significant growth potential to long-term investors who can tolerate the volatile stock price swings in the short term. They may be highly effective by the competition and uncertain characteristics of the untried markets and also more susceptible to economic downturn due to the availability of limited resources. What are the factors that impact the market cap? Significant change in the value of the shares, whether up or down, could impact, as it in turn affects the number of shares issued. Any excise of warrants on a company's stock will increase the number of outstanding shares, thereby diluting its existing value. The excise of warrants can potentially impact the company's market cap as they are typically done below the market price of the shares. We need to evaluate our financial goals, risk tolerance, and time horizon in order to build a portfolio with a proper mix of all the three market caps. A diversified portfolio contains a variety of market caps which may help us in reducing investment risk in any one area and support us to pursue our long-term financial goals. Well, thank you so much for watching. Please like this video and do share.